This is actually quite funny. A girl I was dating once, she said to me, "You know, you remind me of RuPaul." And RuPaul is a famous fucking drag queen, so it's not very good. I was like, "Why?" She goes, "Because he has a saying. He said, I always knew I was famous. I had to wait for the rest of the world to catch up." And she goes, "You have the same mindset." And she said this to me before I had nothing, because I told everyone I'm going to be world champion years before I even had a British title, before I even had an English title. I just started fighting. I was like, "Oh, I'm the next world champion." Yeah. And I just started saying it, but I said it with genuine conviction. I knew I would be the best. I genuinely knew I would be the best. You have to understand that this world, everyone constantly tells you, do not be arrogant. Do not have an ego. When I had my Twitter, I put my ego into overdrive because I found it entertaining. But people will constantly...
What's going on, guys? It's your boy Tyler bringing you fundamental news on the 24th of May. Today's article is brought to you by Trading Point. Forget default. Is a debt ceiling deal the true risk for stocks? With US lawmakers unable to reach a deal on the debt ceiling, investors are laser focused on the risk of a catastrophic default. However, the real problem for markets might be what happens after an agreement is found. That's when the Treasury will scramble to raise its cash levels, which can drain liquidity out of the financial system and in the process inflict damage on riskier assets such as stocks, especially your tech stocks, your Nasdaq. Once the Fed drains liquidity, Nasdaq is going to fall. Political theater. It's almost certain that US lawmakers will ultimately reach a debt ceiling deal, even if it takes some time. Nobody really wants the US government to default, as that would severely damage the nation's credibility, raise borrowing costs, and make matters worse for both parties. This showdown is a political game of chicken, and investors are fully aware. Republicans want the government to slash spending, whereas the Democrats are only prepared to freeze public spending at current levels. Some compromise will eventually be found, hopefully before the ex-date that Treasury Secretary Janet Yellen has warned is around early June. US debt hits the ceiling. Investors worried about default, but real risk is the aftermath of the deal. Well over 30 trillion. The US is indebted in well over 30 trillion. In reality, there are some extraordinary measures the Treasury can take to avert default for a few more weeks, so the real ex-date might be closer to late June. Even so, the real question is, what will happen in the aftermath of the resolution? Liquidity drain. Once a deal is found, the Treasury would need to sharply boost its borrowing in order to replenish its cash levels and be able to honor the spending obligations of the US government. This means a flood of newly issued bonds will hit the markets in the following weeks, which investors need to absorb. Let's dig into the numbers. The government's cash account at the Fed, called the Treasury General Account, currently stands at 60 billion. According to the Treasury's own estimates, this cash balance is expected to soar to 550 billion at the end of this quarter and then rise to 600 billion by the third quarter. Treasury quickly running out of cash. One deal is reached, ensuing cash rebuild can suck oxygen out of markets. This implies that around $500 billion might be drained from the private sector, reducing bank reserves and in the process siphoning liquidity out of financial markets. This is very dangerous. In the private sector, that includes real estate. So if they decrease the liquidity, it's going to affect the commercial real estate market. Liquidity is the lifeblood of the financial system, so a sharp reduction would spell bad news for riskier assets such as stocks and cryptocurrencies, and that's without even considering the Fed's quantitative tightening program, which is reducing its balance sheet at a steady pace. Hence, it looks like the Fed and the Treasury will be simultaneously pulling liquidity out of the US markets this summer, effectively sucking oxygen out of the room. Quantitative tightening kicks into overdrive. Markets have essentially taken a break from quantitative tightening since last October. Since then, the Fed has shrunk its balance sheet by only 300 billion, but the Bank of Japan and the People's Bank of China have jointly injected around 1.2 trillion into their own financial systems. Liquidity is a global phenomenon, so the tremendous expansion in China and Japan have more than eclipsed the Fed's cautious efforts to remove liquidity. It is probably not a coincidence that stock markets bottomed in early October, exactly when these foreign liquidity injections started. But this liquidity effect seems to be going into reverse now. The balance sheets of the Japanese and the Chinese central banks have been falling in recent weeks. The Fed is still reducing its own balance sheet, and the Treasury is about to turbocharge this process. Market effects. Blending everything together, investors are staring down the barrel of a dramatic liquidity extraction in the coming month, just as the real economy starts to feel the lagged impact of the previous rate increases. This is important because it could mark the end of the stunning rally in risk assets. Long duration plays such as tech stocks or shares of speculative profitless companies would likely get hit the hardest, alongside cryptocurrencies. The riskier the investment, the more vulnerable it is in an environment of evaporating liquidity. With the tech-heavy Nasdaq rising by nearly 27% so far this year and Bitcoin rallying 64% over the same time frame, these instruments already seem overextended and susceptible to a deep correction. Yeah, Nasdaq has to retrace. We way above. I think we're at about 13,700, right? Yeah, but I think we're gonna retrace to like 1300s. Anyway, in contrast, the main beneficiary in the FX arena might be the US dollar, which tends to perform well when liquidity dries up and markets sell off. In conclusion, investors seem to be focusing on the wrong risk. Even if the US government shuts down next month, the politicians will eventually strike a deal. What's most important is what happens afterwards, once the Treasury unleashes a tsunami of bond issuance, amplifying the effects of quantitative tightening. There you have it, guys. US debt ceiling. Don't forget to like and subscribe and tell your friends.